Hello everyone, and welcome back to my class. Today we will discuss topic 11, Introduction to Financial Statements, and in particular we will focus on the income statement. So in the previous class we discussed the balance sheet, which is a snapshot of the assets and liabilities that the company has at one point in time, while today discussing income statement, we will see the revenues, costs, and profit of a company across a certain time. It can be 1 quarter, 6 months, or maybe 12 months. So let's dig inside this interesting topic. So what's inside an income statement? So you start usually with revenue. So at the top of your income statement, you will have revenues or sales. So how much revenues your company has generated. For example, let's say $100,000. The second line is the cost of goods sold. So this is the direct costs that are related to the revenues that you have generated. So for example, in the case of Coca Cola, you can think about raw materials. So maybe the aluminum that goes inside a can, the sugar, the water, and all the direct costs that affects the sales of Coca Cola. If you do revenues minus cost of goods sold, you get something called gross profit. So assuming it's 100,000 minus 30,000 in cost of goods sold, the company gross profit is $70,000. After that, you get sort of indirect costs. They're also called operating expenses. For example, rent or marketing. So costs that are not directly and specifically related to selling 1 can of Coke. Once you deduct these operating expenses, can also be, for example, the salaries of the CEO, you get something called EBITDA, which means earnings before interest, tax, depreciation, and amortization. Once you have subtracted these costs, additional costs such as depreciation and amortization, you get the same word, but without the last 2 letters, so you get EBIT, which, as the word suggests, is earnings before interest and tax. Then you deduct interest and taxation, and you arrive at the last line, which is called net income or profit. So you start from revenues, you deduct the direct cost, indirect cost, depreciation and amortization, interest, tax, and finally, you have your net income. So this is what's inside an income statement. Let's see an example. So in the previous class, we discussed the balance sheet of Coca-Cola. Today, we discussed the income statement of Coca-Cola. So you can see that in top here, you get the revenues of Coca-Cola. So in 2016, Coca-Cola generated 41 billion, almost $42 billion in revenues. The cost of goods sold to sell these revenues, to sell these Coca-Cola bottles and cans, was $16 billion. If you deduct $16 billion here to $41 billion, you get the gross profit of $25 billion. From this calculation, you can understand that when you buy a pack of Coca-Cola and you pay, for example, $4 or $41, Coca-Cola only spends $16 to directly produce that can of Coke, which, as we know, is probably mostly water and sugar, so it's not very expensive. After that, you have some indirect costs. For example, you have here, they call them selling general administrative expenses. So there might be some marketing, there might be some salaries. In total, is $15 billion. In this case, Coca-Cola doesn't disclose research and development, but usually you also have research and development costs, and as well as depreciation and amortization. So these costs are not disclosed by Coca-Cola, but most companies do disclose them. This is also a simplified version of the income statement. So if you probably look at the annual statement of Coca-Cola on their website, you will get more details on this. So you can see that the total expenses of Coca-Cola is $33 billion. And this, of course, includes the $16 billion here, and then all these expenses here. So the total is $33 billion. They also get some additional income. You shouldn't spend too much time here, but you can see that if you do 41 billion minus $33 billion in cost, you get the income before tax, so the net profit of Coca-Cola before tax. Finally, if you, they don't disclose again the tax, but here you can see that they're having 6.5 billion of net profit, which means that they've probably paid approximately 1.6 billion in taxes. So you start with $42 billion in revenues, and you end up with $6.5 billion in profits. In the previous slide, we mentioned other concepts such as EBITDA. These are non-official numbers. So when you submit to the government, you usually don't disclose these numbers, but you can keep them in your calculations so that you know where your main costs are, but usually these are non-official numbers. There are some differences between the income statement and the cash flow. So remember, income statements look at revenues and costs and profits. Cash flow looks at the movement in cash. Of course, if you have more revenues, you generally have more cash inflows, but there are some differences. For example, in the income statements, you deduct something called depreciation. And what depreciation is the amount of value that your assets will lose every year. For example, imagine if you have a car. You're buying the car for $10,000 and you think that this car will last you 10 years. So this means that for every year, your house will decline in value by $1,000. So first there will be 10, then 9, 8, 7, and after 10 years, the car will be useless. But if you think about the cash, when you're buying the car, you're losing immediately $10,000. You need to get from your bank account $10,000 and you give it to the dealer. On the other hand, in the income statement, you're only looking at the depreciation. So it will be the cost that you will have for every year will be only $1,000. So in the case of cash flow, you have minus $10,000 and then 0, 0, 0. In the case of income statement, you have minus 1, minus 1, minus 1, and so on. So there will be a difference there. In other cases, there is differences because you need to ignore cash expenditures on new capital investments. Again, for the example of the car, is the same. When you look at the income statement, you will not have the minus $10,000 in the first year. You will only have the minus $1,000, which is the sort of real cost, because you're not having an expense of $10,000. It's a cash outflow, but you're only losing $1,000 a year. So in the income statement, you will not need to put your capital investments, but these will be in your cash flow statement. And finally, the cash flow looks at when the cash comes in and goes out. The income statement tries to have a more realistic picture. So imagine if you are selling a 5-year service. So you say to someone, I will be cleaning your house for 5 years. You pay me $5,000 today and then nothing else for the next 5 years. In the case of cash flow, you will have a cash inflow of $5,000 today and then 0, 0, 0 for the next 5 years. The income statement will be $1,000 per year because you divide the 5,000 income by 5 years. And so we'll assume that each year you are gaining $1,000. And so you can see through these examples that there are differences between income statement and cash flow. They're usually related, but they're not the same things. Also, usually you don't consider changes in working capital, which is the capital you have available for your business. So overall, you can find more definitions online on income statements, but I hope you have enjoyed the class of this simplified version of income statement. Thank you very much for your attention.